Imagine the largest machine on Earth. It has no physical form, yet it moves more value in a single week than the entire world produces in a year. And the thing is, it never, ever stops.
$7,600,000,000,000. That's the amount of money flowing through this invisible system every single day. It's a constant digital tide of capital that ultimately determines the price of, well, almost everything, from the fuel in your car to the food on your table. We're talking about the foreign exchange market. It isn't housed in some single grand building. Instead, it exists in a massive network of computers, connecting banks and financial institutions all across the globe. You can think of it as the financial system's circulatory network. And its health, well, its health is really the health of the entire world economy. So, if you want to understand the real forces behind globalization, trade, and even conflict, you first have to understand the machinery that powers it all. Here at TRADEVERSE, that's what we do. We unpack the complex systems that shape our world.
All right, so to really get our heads around a system of this magnitude, we've got to start by mapping out its architecture. Who are the players involved, and where does all this activity actually take place? Well, it turns out the market operates on a pretty clear hierarchy. Think of it like a pyramid. Right at the very top, you have the central banks and governments. They're intervening to manage their national economies and currency reserves. Just below them, you've got the major commercial and investment banks. They make up what's called the interbank market, and that's where the vast majority of all this volume is traded. Further down the pyramid, you'll find institutional investors, think hedge funds. And then finally, at the base, there's this growing number of individual retail traders, people accessing the market through online brokers. What's fascinating is that this market literally follows the sun. It's a continuous 24-hour cycle. It kicks off with a Sydney session, then it moves to Tokyo, then on to London, which, by the way, is the largest session by volume, and then finally it lands in New York. And just as New York is closing, the cycle starts all over again in Sydney. There is simply no off switch. But the most critical period of the day is this specific 4-hour window when the London and New York sessions overlap. For those 4 hours, you have the world's two largest financial centers trading simultaneously. This creates peak volume, peak liquidity, peak volatility. It's really the market's daily crescendo. Okay, so we've got the players and we've got the timeline. But the next logical question is, how is all this immense value actually quantified and exchanged? To get that, we need to learn the market's specific language. The most fundamental concept here is the currency pair. See, currencies are never traded in isolation. They're always quoted in relation to another one. Take the EUR/USD pair, for example. What that's really asking is a direct question. How many US dollars does it take to buy 1 euro? And the answer to that question, well, that's the exchange rate. Now, the price movements in this market, they're measured in something called pips. That stands for percentage in point. For most currency pairs, a pip is just a tiny fraction of a cent. It's a move in the 4th decimal place. It might seem small, but it's the standardized universal unit for measuring every profit and every loss. And to manage transactions on this kind of massive scale, trade sizes also have to be standardized. They're grouped into what are called lots. So a standard lot, for instance, controls 100,000 units of the base currency. It's this kind of structure that allows a huge, decentralized market to operate with, universal precision. All right, now we've arrived at the mechanism that really defines the modern foreign exchange market. It's a tool that's made the market accessible to millions of people, but it's also the source of its immense risk. We're talking about the double-edged sword of leverage. So what is leverage? At its core, it's basically a loan from a broker. It allows a trader to control a very large position, say a $100,000 standard lot, with a much smaller deposit, which is called margin. Now, this structure amplifies everything. A 1% move in the market could become a 50% gain. But, and this is the critical part, a 1% move against you can trigger a 50% loss with equal, and I mean unforgiving force. And you have to understand, this power is governed by automated, completely impartial protocols. The system is designed first and foremost to protect the broker from catastrophic loss, not the trader. This brings us to the path of liquidation. Here's how it works. As a leveraged trade moves against your position, that initial deposit, the margin, gets eaten away. The system will first issue what's called a margin call. It's an automated demand for more capital. If the trader can't or doesn't add more funds and the losses hit a critical point, the broker's system triggers a stop out. It automatically closes the positions to protect itself from taking on the trader's debt. It is swift, and it is final. So when you're faced with all this complexity and all this risk,
How do participants even begin to try and predict which way the market will move? Well, they primarily operate within two competing schools of thought.
On one side, you have fundamental analysis. This approach tries to understand the why. It looks at a country's economic health, things like interest rates, employment data, geopolitical stability, all to figure out a currency's true intrinsic value. On the other side, you have technical analysis. This school of thought studies the what. It basically ignores all the underlying economics and focuses entirely on historical price charts. The belief here is that all the known information is already baked into the price, and that human psychology creates patterns that repeat over time.
But that raises a pretty big question, doesn't it? If these sophisticated analytical tools exist, why do so many participants still fail? What is the ultimate challenge in navigating this system?
The challenge, as it turns out, isn't really in the market itself, but within ourselves. Human psychology is just prone to these predictable errors, especially under pressure. Things like loss aversion, which makes the pain of a loss feel twice as strong as the pleasure of a gain, causing us to hold on to losing trades for way too long. Or overconfidence bias, which can kick in after a few successful trades and make us ignore our own risk rules. And then there's confirmation bias, where we only look for data that confirms what we already believe, and we ignore all the warning signs. And all of this brings us to the core truth of this entire global machine. Success isn't found in some holy grail indicator or perfect secret strategy. Instead, it's found in the disciplined, rigorous application of risk management. When you step back and look at it, the foreign exchange market is a system of almost unbelievable complexity. It's driven by trillions of dollars, endless data, and major geopolitical events. But for those who choose to participate in it, everything is ultimately governed by a single unwavering principle: discipline.